Hi everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be talking about Exxon Mobil, ticker symbol XOM. All right, for today's stock analysis on Exxon Mobil, I'm going to give my price target, look at 2021 Q3 results, give a brief business description, look at the stock price history, price performance versus peers, the financials and fundamentals. We're going to talk about oil prices briefly, look at dividend information, and lastly, I'll give my final thoughts and considerations for Exxon Mobil as an investment. For those who are new to the channel, I do videos on personal finance, investing, and stock analysis such as this one. So if you like this type of content, please consider subscribing. If you find anything helpful, please hit that like button. Now to your content. All right, my price target for Exxon Mobil is $70 to $80 in the next 12 months. That indicates a 9 to 25% upside from its current value right now. We'll use the rest of this video to go over why that price target is what it is. All right, so Exxon Mobil reported their Q3 2021 earnings on October 29th. They reported $1.58 on an EPS basis compared to analyst estimates at $1.52. So they had a beat there by 6 cents or about 4% beat on earnings per share. On the revenue side, they reported $73.79 billion in revenue compared to analyst estimates at $71.7 or a beat by about $2 billion. And the revenue beat as a percentage is about 2.9%. So beat on both revenue as well as earnings per share. All right, jumping into highlights for Q3 of 2021. So XOM had earnings of about $6 billion in the third quarter. Quarter earnings increased by $7.4 billion. We'll talk a little bit about that a little bit down below. Cash flow from operating activities of $12.1 billion. Anticipate future annual capital investments of $20 to $25 billion. And increase the dividend to 88 cents per share. They authorized a repurchasing program up to $10 billion over 12 to 24 months, and they're on track to reach their emissions reduction plans. Whoop-de-doo. On the third quarter, you can see starting to look at some of the financials. We'll go more in depth later. You can see this is where they had that big increase from 2020 to 2021. You saw this with a lot of companies. Nothing crazy here. Huge dip and negative earnings for most of 2020. For the first 9 months, you can see where they are. Large percentage of the first 9 months is being realized in the third quarter. Same with the on a per share basis here. And if we go down to capital exploration and expenditures, you can see that this has been pretty stable throughout the year, but it's still considerably lower than it was in 2020. And that is where they are trying to address that up here, where they're saying they're going to be increasing CapEx in 2022 closer to where they were in the year prior in 2020, probably a little bit higher. Now, if we scroll down into the business segments, average realization of crude oil increased 7% in the quarter, or 7% from the second quarter, and natural gas was up 28%. Liquid volumes increased by 5%. That was driven by lower planned maintenance activity. Looks like they had about 500 oil equivalent barrels per day, an increase of approximately 30% from in the third quarter, so that's good. Focus continues on grow free cash flow by lowering overall development costs and increasing recovery through efficiency gains and technology applications. Good to see that they're focusing on that. Definitely want more free cash flow if possible. Nothing super huge here on the downstream side. Doesn't look crazy. Exxon secured 3 million barrels from the U.S. Strategic Petroleum to produce essential fuel supply, delivering record terminal throughput rates. Nothing crazy there. On the chemical side, quarterly earnings of $2.1 billion reflect reliable operations coupled with strong demand. So really good part of the business right here, bringing in a nice chunk on the earnings side. Going into capital allocation a little bit more in detail. So they're going to be aiming for 20 to 25, up from 16 to 19 billion dollars in capex for from 2021 to 2022. During the company paid down debt by $4 billion. Year to date, Exxon has reduced debt by $11 billion and has improved total debt debt to capital ratio to 25%. And they expect to maintain that in the range of 20 to 25%. I'm going to go a little bit more further into these financials later on, and overall that looks pretty good. Don't really care about emission status. All right, now quickly for a brief business description of XOM, Exxon Mobil. Now they're mainly focused in the upstream and downstream segments of the oil and gas industry. I believe they are in the midstream business. They're just not heavily there. They definitely do a lot of everything. So they do a lot of oil and gas exploration, a lot of distribution as well as refining. They also have a chemicals business that they operate as well. So one of the largest integrated oil companies in the world, top two in the U.S. You got XOM and you got CVX, Chevron, and you know its other competitors across the world is like BP, British Petroleum. You have Royal Dutch Shell, and others as well. So it's just one of the big integrated oil players in the world. All right, jumping to the stock price history for XOM. Starting at the 5-year mark on here, you can see that it traded as high as $90, $91. And it had been trading down till the right before the pandemic, and was already down 23% in that time period. If you held it all the way down to the pandemic, you're down 63%. But even if you bought it right before the pandemic, you're down at least 50%. So thankfully, I timed this pretty good. Got really good cost basis on XOM. I was able to buy $31, $32. And I wish I would have sold and then rebought in this up period, and then it went back down and had another buying opportunity. But yeah, I've held on to my XOM and up until today, and we're still looking at getting to that $70 to $80 price target. Now, bringing that down into the year mark on how it's performed, it's been pretty steady to start the year, making most of the gains, and then from there it's remained pretty flat, since March of this year. Really bouncing between low 50s up until the low 60s, mid 60s at the high. So there is. So we'll talk about kind of why that's happening, but if we're looking at a little bit of a longer term, let's say over the last decade, the floor is kind of around $50, $60 in terms of where it was trading at pre-pandemic. So I think, there is a decent floor on this. I don't think it's going to be going back to $40 or $30 anytime soon. There would need to be a really big supply or demand issue that would either extreme oversupply or something that happened during the pandemic where the demand just went to zero. So there would have to be something else. So I don't see this going, significantly lower back into the $30 or $40 range anytime soon. All right, moving into price performance versus its peers. Just first off, this doesn't include any dividends. So this is a pure, capital appreciation metric. This does not include returns for dividends. So over the last 10 years, we have XOM in gray, CVX, Chevron in blue, Royal Dutch Shell in yellow, British Petroleum in purple, and SPY, the S&P 500 index, is in green. And you can see over the last 10 years, SPY is really the one above all others and has had great returns over that period, with all the others either having negative and CVX only having a 10% return over a 10-year period. So really terrible capital appreciation returns there. Jumping down into the 5-year mark, it's not much better. Still negative for most, slightly better for CVX, like slightly positive for CVX, I should say, and over 100% for the SPY. Looking at the 3-year chart, it's much of the same, SPY blowing them out. Now looking at the 2-year chart, really much the same as well. Now on the 1-year chart, this is where I expected things to shift. If you've been watching oil over the pandemic, there was a huge discount in oil companies across the board, anywhere from 50 to 75% discount that happened quickly right after the pandemic started and for several months following. So there was a good opportunity to buy. So in the last year, XOM is actually leading the charge, up 65%. You have BP and Royal Dutch Shell following in at 36 and 38% up in the last year. And you have SPY actually at the very bottom of all this, and CVX slightly beating that out. I'm going to go ahead and drop into the 9 and 6 months. And you can see over the 9 and 6 months, they're still beating the SPY, but not nearly by the same margin. So things are starting to normalize a little bit here, you can say. But over the 6-month mark, I imagined I was going to see this, was the SPY is beating most of the oil companies. As I said earlier, over the last 6 months, oil prices have been improving, but the price of these oil majors have basically kind of been a little bit more stagnant and less upside. Where you have seen some growth is in Royal Dutch Shell. And on the 3 months mark, I anticipate the SPY to actually beat them, but that's not the case. Where I'm going with all this is, over the last several years, the oil majors have stayed relatively, from a capital appreciation perspective, have not increased that much. In fact, have been pretty negative. There was a good opportunity to trade them, and I still think they're slightly underpriced to what they were pre-pandemic. And so you just need to have some tapered expectations for long-term returns versus short-term returns with these oil plays. All right, jumping to the financials for XOM. Looking at total revenue, 2018 was $281 billion, 2019 $255, so slight decline there. 2020, 30% decline in revenues. And if you look at net income, was huge loss, $22 billion. And you can see that's just just massive loss in 2020. Yeah, it's just crazy. Year-over-year growth on the EPS side, even though revenues were only down 30%, huge slide in earnings per share. I mean, just massive loss there. So going into the quarterly basis, what we want to do is actually compare the revenues versus 2019. So if we look at their Q3 of 2021, it's $72 million or $72 billion in revenue versus Q3 of 2019 at 63. So we're actually having an improvement of a good $10 billion, roughly $10 billion. So a little less than 20% improvement compared to the 2019 numbers. So really good to see that. And yeah, so the point driving that home, net income at 6.7 versus net income of 3.1. So being able to translate that $10 billion into a higher net income margin. So we saw it 5 in 2019 to 10. So doubling the net income margin is really good, impressive there, just on $10 billion in extra revenue. Now, let me temper some expectations moving forward. In 2022, I think revenues are going to stay pretty stable if we have similar demand and prices of oil remain pretty flat. What will change, though, is their CapEx spend is going to increase from either 16 to 19 billion to 20 to 25. So we are going to see a little bit of net income margin loss just because they're moving their CapEx to what it was back in 2019, roughly. So that could be what is accounting for the difference in this margin here. But they have had 10% margins before. But it is really good to see that they're having, they're translating that down to the earnings per share and bringing that back to investors. All right, jumping on over to the balance sheet, let's look at what they're doing on assets. So total cash and short-term investments at 4.7, receivables at 29, total current assets at 55, plant equipment at 218 billion, long-term investments at 36, total assets $336 billion, total current liabilities at 61 compared to total current assets at 55, so a little bit of a deficit there by $6-7 billion. So they're gonna need to be able to raise that either in receivables increasing or have to issue debt or something to pay for that. Total liabilities at 169 Looks like only $43 billion in long-term debt, which seems like if they wanted to prioritize debt payment, they could. So, debt to equity doesn't seem super crazy right here to me. So total assets at 336, and you have liabilities at only total liabilities 169 billion. So it doesn't look bad. Looking at the last 5 years, shares outstanding has remained fairly stable. It looks like this would probably decrease slightly. They had a $10 billion in share buybacks authorized for 2022. That is a small percentage of their market cap at around 270 billion. So I don't think it's not going to affect the stock price in a huge way, but it is good that they're not issuing new shares and diluting the company. Now let's talk a little bit about oil prices and how they affect Exxon's pricing. Now we know the commodity oil price is very influential on XOM's stock price. The reason for this is, particularly in the upstream business, it's where they get the most margin if prices increase. And if prices decrease, there's less margin on the very baseline cost of production. So as oil prices increase, the biggest place where they get improvement is on the upstream business. On downstream, their input costs are more because upstream is actually making more money, so they have to pay more for product, but then they pass that on to the consumer. So it's really a wash on the downstream side, a little bit more stable revenues, and even though as cost goes up, they're still able to pass that on pretty well. So pretty stable on the downstream business. The upstream business is where you're going to really see the benefit of higher oil prices at Exxon. Now, with that being said, because they're fully integrated, you're really not going to see the spike in the effect of oil prices going up as a pure play upstream business would, right? And on the reverse of that, as oil prices go down, you're not going to see nearly the impact. Again, they are hedged in that manner where there's a little bit more security on the downstream side, and then really the upstream business is very, very influenced by the commodity price of oil. So what do we think oil prices are going to do in the next year? What do we think oil prices are going to do in the next 5 years? Well, 5 years is pretty hard to tell, but let's bring it down into the 1 year mark. I still think we have a really good chance to get to $100 oil, possibly 120. If that's the case, we could see Exxon going up into that $70, $80 range pretty easily, in my opinion, all the way up to $100 a share if we see commodity prices jump into the 120 range for a extended period of time, let's say about 6 to 8 months. I think you definitely will start to see that affecting Exxon's oil stock price. So oil prices are going to have to be something you monitor if you're looking for future capital appreciation in Exxon. All right, next up, let's talk about dividend information. Right now, the annual dividend is $3.52 a share. Dividend yield is around 5.5% right now, and the next ex-dividend date is on the 10th of November, which is actually already passed at this point. If we're looking at increases over time, you can see right before the pandemic, they were at 87 cents a share. There was no pause in the dividend throughout 2020. And they maintain their dividend at the cost of increasing debt. And they actually had a recent increase of 1 cent per share in the last, actually that was what we discussed earlier, where they increased it by one cent. So really good, stable dividend here. Not much to worry about. The leadership has definitely made it very clear that the dividend is a priority, and they will maintain that. While other oil companies cut their dividend or slash them completely for a period of time, Exxon would remain committed to their shareholders and those reliant on the dividend. So I don't expect that to change while oil is good, because they just got out of a really negative time where oil was bad. So pretty stable and reliable dividend moving forward. All right, just to drive home the fact that the dividend is secure from a leadership perspective, or at least the leadership seems committed to the dividend. So if we look at the payout ratio, that's essentially the dividend divided by earnings per share, and that gives you a percentage of how much they're paying out versus. So something that a payout ratio under 100 means that they have more earnings per share than they're paying out in the dividend, and something above means they're paying out more than what they have on an earnings per share basis. You want that to be lower, typically, than 100%, right? Secure dividend, I would say, is around 50%, 50 to 60%. You can get it as high as 80% in cases that have very secure and consistent cash flows. And oil is typically in that category. And one of the things I just wanted to drive home here is that in 2020, they had massive, really big losses, and they still maintained their hefty dividend. And so now that things are getting better, I don't anticipate that to change. And the payout ratio in the last quarter being around 55%, that's very, very secure for an oil company. So I think this is going to be really solid moving forward. Okay, my thoughts on Exxon are as such. I do believe the price target is very reasonable and conservative of $70 to $80 in the next 12 months. There's a lot of historical data to support that. Revenues are back, EBITDA's back, net income looks to be in the right direction, free cash flow looks to be going in the right direction, and the company is starting to bring back some of their capital expenditures that will help sustain production into the future and help keep their cash flows to remain consistent moving forward. They are doing share buybacks. Their dividend payout ratio looks to be starting to get to a place that is sustainable. They're trying to address and will continue to address their debt to try to keep them in an investment grade territory. There's a lot of good things going on with Exxon. They did really well, I think, relatively speaking, through the pandemic at trying to minimize impact to dividend holders. And it was a great investment opportunity for those that saw a company at decade low or longer. I mean, in some cases, these companies were trading at 2 decades, 20-year lows, and it was just obvious to go into them. And XOM for me was one of the first companies I invested in during the pandemic because there was all that stuff going on with Exxon or OPEC, and oil prices demand was just gone. And I was like, this can't last. Like, we're not going EV that quick, right? All that being said this is going to be a play on short-term play for me. We're looking at oil prices, in my opinion, getting up to $100 pretty quickly. I think 6 to 12 months could happen. We do need to monitor OPEC. We do need to monitor oil supply and make sure that doesn't go out of whack and start to bring down prices. There's there still is momentum in oil stocks right now. As far as the stock price itself, everything looks good. And I think that from a historical perspective and previous valuations of these companies, there's still room to run. Now, on the high side, I do think Exxon has the ability to get to $90 to $100. It is possible, right? If things keep going the way they are on oil prices and they sustain at 120, which I think that's a little far-fetched, right? But I still think there's maybe 10% chance maybe that oil prices get into the $120 range. And if they're able to sustain that for at least 6 months, maybe a year, there's going to be, these companies are going to be just printing money. And at some point, investors are going to see that and say, okay, there's good value here, and they're going to ignore the long term. These, oil companies are cyclical as they relate to oil commodity prices. And, investors will flow into it when things are good, and then they flow out of it when things get bad. Now there's still a chance, I think, to ride this on the wave up and sell it before it goes down. So we're going to need to pay attention to oil commodity prices. We're going to need to also pay attention to momentum on this. I think around $70 to $80, I think, is pretty, I'm not going to say 100% sure that it's secured, but I think there's a very, very, very good chance. This is almost 90% confidence in my mind that it will reach those levels. Within the year. I really do believe that. So, and it's not far from 70 already, right? And it doesn't really affect their market cap all that much. It's not far-fetched to believe that. $100 oil, $100 Exxon. Now that is, that would be, very low Like I said, 10% chance maybe, on the very aggressive side there. Again, that relies on commodity prices and, a lot of other things. So right now, I do plan to hold on to Exxon until I see a shift in momentum or commodity prices. I do not see oil as a long-term investment. There's nothing historically that has proven them to have returns over long periods of time that I want to see from a capital appreciation perspective. Now, if you're a dividend investor and you're looking for secure cash flows moving forward, Exxon, I believe, has demonstrated that they're committed to the dividend. They're not going to, leave you stranded like Shell did during the pandemic, slash it, and then come back with something that just so small compared to what they were before. Sorry, but I got to throw Shell under the bus for that. But if you are a dividend investor, you got to be pretty confident in leadership's commitment to the dividend moving forward. They, I think, have well proven themselves on that. Thank you so much for watching today's video. My name is Frank. If you like this type of content, please consider subscribing. I do videos on personal finance, investing, and stock analysis such as this one. If you found anything helpful, please hit that like button. It helps me out a lot. Thank you so much for watching. Frank Finance, out.